To open the session, please welcome CEO of Invest in Canada, Ian MacKay.
Good morning, ladies and gentlemen. My name is Ian MacKay. I'm the CEO of Invest in Canada in Ottawa, Canada, and I'm just delighted to be here today. I want to thank Mr. Milken and his staff for giving me the opportunity to take a few minutes. You're in for a treat with the panel that's upcoming, Uncertain Times, the State of Global Capital Markets. You're going to see some data and research and analytics that will probably change your minds a lot about how the world's going to unfold in the next little while. I'm going to take a few minutes on a different tack, a little geopolitical overview that's affecting my country, Canada, but perhaps how it might impact the entire Asia-Pacific. So this week, you're going to be talking about uncertainty and disorder and chaos. Well, Canada has had a front row view of those concepts for the past couple of years as we grapple with a different type of future in the world's largest bilateral trading relationship, that is the Canada-US trading relationship. And as I look at the themes being discussed at this remarkable forum, I'm reminded that the 24 hours that it took me to get here from Ottawa are a long way away from the Asia-Pacific, but Canada considers itself very much an Asia-Pacific nation. Validated and strengthened earlier this year by our signing of the Trans-Pacific Partnership, Canada knows that our inclusion in and our relationship with the Asia-Pacific will be a defining factor for us economically and politically for a century ahead. And we embrace this reality, secure in the knowledge that our ties to the Asia-Pacific are deep and strategic, necessary and sustainable. But you might be asking, why would this audience give much consideration to Canada as you deliberate in your panel sessions topics such as sustainable economies, feeding the world, artificial intelligence, and the New World Disorder? Well, we have to say something about all of those topics and much more, but just very briefly on sustainable economic development, we have 15 of the world's top 100 clean tech companies, all of whom have the capacity to export their solutions to the Asia-Pacific. On feeding the world with healthier food, Canada's prairies are home to a supercluster of bioprotein companies who are now using AI to increase productivity and reduce the need for pesticides in crop production. With respect to artificial intelligence, which will take up a lot of the discussion throughout this week, many in this room will know the names Geoffrey Hinton, Joshua Bengio, Richard Sutton, Geordie Rose, four of the brightest minds in artificial intelligence research, but all of whom are practicing their particular brand of magic in Canada. And the investments, the startups, the ecosystems building up around them are amongst the world's best. And as I'm sure you've all read recently, we have, as I said, a front row view at what one of your panels is describing as world disorder. The Canada-US relationship has been rocked, but instead of viewing this as a detriment, we view it as an extraordinary opportunity to present competitive advantages to the global investment community. I think we've been preparing for this moment for quite a while. Canada has the most favorable trade footprint in the OECD. Free trade with NAFTA, free trade with the European Union, and as I mentioned, free trade in the Trans-Pacific Partnership, plus 14 other bilateral trade agreements that have taken a country of 36 million people into a marketplace of 1.6 billion consumers. Canada has a highly educated, multicultural, multilingual workforce, and importantly, a new immigration framework that allows companies operating in Canada to secure their talent anywhere in the world within as little as 14 days. This is a game changer, and as a direct result of this, for the first time ever in the tech industry, tech talent from around the world migrating to centers like Toronto and Vancouver have surpassed the tech migrants going to Seattle and San Francisco. This is a significant shift. So the trend is becoming clear. Unfettered access to a market of 1.6 billion people, the world's most educated workforce, a business-first immigration policy, and a demonstrated capacity to be the Asia-Pacific gateway to North America. Canada is actually becoming a preferred choice for 21st century knowledge-based investors. So disorder, disruption, chaos, however we're describing the volatile and changing investment landscape, Canada is becoming a bit of an oasis, countering all of these emerging realities by providing global market access, an abundance of world-class talent, and a supportive, stable, progressive government that will never insult your companies, but will always help and support and further the advantages of your companies. I thank you for your time today. You're in for a treat. As I said, this panel has some extraordinary data sets that they're going to be talking about, that'll talk about everything from demographics to cap sheets to the flow of capital, and I know you're going to enjoy it. Thank you so much for your time.
Ladies and gentlemen, please welcome your panel on Uncertain Times, the State of Global Capital Markets, moderated by the Institute's chairman, Michael Milken.
So today we have 4 of the world's leading money managers, but we also, you'll see by the end of the session, have 4 of the world's leading social scientists. The very first speech I gave in the financial community, late 1960s, 68, 9, was the best investor is a social scientist. And you'll see today, as we focus on issues of capital markets, up and down the balance sheet, all areas of the world, that in many ways, all 4 of them are really social scientists from that standpoint. Before we begin the panel, I'd like to just provide one question here, a little background, because I think one of the things we try to do at the 275 events the Milken Institute puts on around the world is give you a perspective. So poverty in the world, and we could call it extreme poverty, 1800, 85% of all humanity lived in extreme poverty. As we get to 1997, just looking at China, 42% of China and India's populations, which made up about 40% of all people in the world, still lived in extreme poverty. So our question, in 2017, what percent of the Chinese people were living in extreme poverty? Less than 1, 5, 13, 21, or 24. So the world's largest population was at 42%. By 2017, what was it? So we're going to give you 5 seconds to talk it over. Time's up. Okay. So how many of you believe it was 24%? They went from 42 to 24%. 21%. 13%. Large, 5%. Less than 1%. A handful. Answer? So when we talk about getting a true picture of the world, this amazing thing that occurred in China, extreme poverty in the world, this is for the entire world, 85, 55, 15. Dramatic changes. For most of the people in the world, today is the best day ever in the history of their life. And so as you look at the number of people in 20 years, here we're looking at over 800 million people on the planet that have been lifted from extreme poverty from that standpoint. And so as a perspective here, and a lot of that has been due to the access of capital and other changes that have occurred around the world. And so we're going to begin this session going from left to right with Elfrin. You're first from Varde Partners, talking first in a few minutes, what is their firm's commission, strategy, how are they structured? So Elfrin, tell us a little bit about your firm.
Thanks very much, Mike. Well, Varde Partners is investing across the global alternative credit markets, and so we look at ourselves as really being involved in liquid and illiquid credit markets all around the world. The roots of our firm are in the stressed and distressed credit markets, so credit that is in dislocation or requires some workout. That's really still our core business today. But we've grown to be investing across a lot of different credit markets. So we have a big business in credit hedge funds. We have a big credit origination business and private debt origination business. And really, I think it will come to be one of the really interesting topics of this panel. We're participating more broadly in how technology and how alternative credit can replace and disintermediate the traditional financial system. And so we own, through our private equity investments, a number of large credit investing platforms, predominantly in the consumer area. And that's, to me, it's a really interesting aspect of today's panel and discussion will be around how technology and how alternative credit or alternative forms of financing are really providing more access to credit around the world.
Give us just 1 or 2 minutes here on where you're partners and how you interact with one another around the world.
Yeah, I mean, we have a very global business. So we're right about to open our 15th office, which will be in Mumbai, India, and we'll open at the end of this year. We have partners all around the world. We're a partner-led and owned business. And I think we always say to our LPs and we say to the investor community, we really see a critical piece of what we do and a critical piece of our investing model is the ability to do global relative value and to stay connected and understand not just that we're doing the best form of our investing in a specific market, but that we're connected and that we're talking properly about where that value is world-class, not just as good as it can be in its local market. And so, we've really invested a lot in thinking about how to stay connected as a firm. I think we do a good job of the connectivity of conversation, not just face-to-face, but also through the use of some technology. And I think we instill that in our partners and in our portfolio companies as well. And so we've really invested a lot over this last 4 or 5 years thinking about how to use technology better, not just as a firm, but also in our portfolio companies, in credit scoring, in how they think about risk.
Technology, Noble, is kind of music to your ears. Tell us a little bit about Two Sigma.
Thank you, Mike. Well, Two Sigma is a technology company. We were founded in 2001. Our mission is to discover value in the world's data. And our founders, one is a mathematician, the other one is a computer scientist, had a pretty simple but pretty profound vision, and that was that technology, with the explosion of data that's been taking place, was going to change every industry. And there was no reason why investment management would escape that. And so the trends that we saw in the US equity market back in 2001, 2002, turned out to be the right ones and turned out to propagate to every other market in the world, or most other markets in the world. And so what started in US equities, electronification, the explosion of data today exists in more than 40 equity markets, hundreds of macro markets, and that's allowed us to sort of capitalize on that trend. 2/3 of our people, we today have nearly 1,500 people, 2/3 of our people are technical folks. So engineers, mathematicians, data scientists. 72% of them don't even have a background in finance until they joined our company. So it's a very different kind of company. Today we've grown to manage $55 billion on behalf of major global institutions. And we're busy at work because the market doesn't get any easier. There is an explosion of data and the markets are growing more efficient, but there continues to be opportunities if you can build and deliver the right sort of engineering capabilities.
Thank you. Sir Michael Hensey, when you and I talk often, wherever you or I are in the world, it's always a discussion of social issues, government leadership, etc. Tell us a little bit about the firm you founded, CQS.
Okay. Again, thank you very much, Michael. And again, thank you very much for all the thinking that you've helped me do over the years. But in 1999, I founded the firm. Obviously, we're approaching our 20th anniversary. We are credit focused, but we do go across the whole capital structure, which is, I think, critical. The real driver for our firm is our clients, solving our clients' problems, thinking about how that is, and working out how to manage that $18 billion the most effective way we can. And the real challenge we all have, and I think everybody in this room has, is how do we go from knowledge to insight? Because the reality is we get paid for insight. And clearly, deep fundamental work is critical to that, but also knowledge to insight, you need imagination. And to that end, you'd need to think about the social issues, the geopolitical issues, and again, that is where I believe the disruption happens, and that's where I believe the extra alpha is created.
Thank you, Michael. And Christopher, tell us a little bit about Barings.
Well, thank you. Barings is a global investment firm. We also invest across the capital structure around the world, about $300 billion or more in assets under management, ranging from private equity and real estate through to direct lending, emerging markets equities, emerging markets debt, high yields, investment grade. I think our approach is very much fundamentally driven in the sense that we think it's important to not only understand the local environment in which we're investing, but also to understand the global political trends underway and to focus particularly on the business models of the firms in which we're investing and the economic and technological pressures that are forcing them to change and evolve and where we can find new opportunities for our clients.
So Christopher, give us a couple minutes. We have portfolio managers up here, founders of firm. Your title is a little different if the people haven't read it. Head of Macroeconomic and Geopolitical Research for Barings Worldwide.
Say that 3 times fast.
Okay. Tell us a little bit about your responsibilities to your partners around the world.
So our team has a twofold mission. First of all, within the firm, which is, as I described to you, large, dispersed around the world, focusing on a lot of different perspectives and investment challenges, to share ideas across those investment teams, because we have experts working in private equity on agricultural commodities, we have experts in high yield working on the same sets of issues from a different angle. So we try to make sure that they know about one another and can help share perspectives from those different team analyses. And then separately, we try to work with our clients and other audiences to try and think through the broader investment themes that any investor with a long-term time horizon faces, whether it's the political trends that we're going to talk about in a little bit, the economic trends that I think everybody is challenged with, and the technological trends, how new inventions, new ways of shaping and using data, remote sensing, mobile networks really are forcing every single business to rethink its business model.
So Elvin, let's go to you. Let's address some of the things you're focused on as you think about capital markets. And one of the areas I'd like you to talk about is the work you're doing in India and the opportunities you see in that region. What will be the world's largest population in the future, and a country that is rapidly moving from large percentage of their populations in severe poverty into higher levels.
Yeah.
So let's first step back. What are the things that you're focused on? And second, take us to India.
Sure. If you look at the opportunity set, I think for our firm globally, it tends to come from a few different places. And 2 of those really go through the whole history of our firm. They're systems that get into trouble, so places where you see large accumulations of NPLs, or they're cyclical issues, either in individual credits or in industries or economies as a whole. And the third part of it, which is really, to me, is really where our industry, where alternative credit has evolved to, is in providing capital to pieces of the economy or pieces of capital markets where it's not being adequately provided by the existing system. And so when you ask the question, where do things come for us generally as a firm, it's usually from one of those 3 sources. And there's a lot going on in that matrix around the world at the moment. And I think, when we pull back to the topic of global markets and what's going on, to me, one of the big things is there's a little bit too much fixation on the world as this kind of unified thing with a single cycle where everything in a way comes back to what's going on in the US equity market or the US credit market. And I think, we all know in this room and we all know up here, the world's a lot more complex than that. Markets are enormous globally. Speaking from our perspective on the credit markets, they've grown an enormous amount over this past decade. And so there's always something going on, and we kind of never get despondent about opportunity set. Of course, it waxes and wanes in different places. But once you unlayer the complexity of investing, there's always something going on. And so I would say if you think about systems that have problems to deal with or places where alternative credit is required, there's still a lot to do in Europe, the periphery of Europe particularly. India is actually one of those, and I'll come back to it in addressing that point on India. There's enough dislocation and cyclical stuff going on as well, and I think we'll talk later on in this panel about where technology is creating some of that cyclical impact, but of course we're still processing what happened in the energy and commodity space in 2015 and 16, and we're starting to work out as a team and as an industry what to do with emerging market stress. And then I think the biggest thing to me and the biggest change is this point about how we provide capital where it's not being done adequately by the existing market. And so we do a lot more these days in terms of providing individual loans that we're originating and underwriting that typically would have been done by a banking system, or in owning businesses that are doing that. And one big force there has been regulatory, where traditional financial institutions have been effectively forced to sell those, and that's been a rich playground for us. And another one is technological, because I think the ability of existing and traditional financing institutions to do credit well in a technological world is increasingly lowered. And so if I speak then to India, and maybe you could pull up those couple of slides. India is in a way the perfect confluence of these things, because on one hand you've got, as represented on the right-hand side of that slide, you've got one of the biggest NPL problems in the world in the country. And one of the features of accumulating NPLs is they tend to keep happening until a government or a regulator does something.
Let's tell them what the acronym means. There might be a few.
Non-performing loans. So non-performing loan issues, you see there, we've represented 3 of the bigger ones in the world: Spain, Italy, and India. India is really right up there in terms of the accumulation of NPLs in its system. And that's one thing, but you actually need proactive government action usually to make those things clear out of a system. I think you can see from the relative growth rates of countries in Europe, that's usually a good thing for your market and economy. And it's nice to be able to talk about, from a government perspective, some governments that are doing some good things. I think the Indian government has really proactively reformed bankruptcy, taken a stick to the banking system and said, you will deal with this problem, and provided the system the tools to do that. So on one hand, we have a systemic opportunity that is creating a role for alternative credit in helping solve the NPL issue of the country. And on the other end of the spectrum, and you referred to this in your comments, you have one of the highest growing and highest demand for capital economies in the world, where you don't have all of the traditional sources of credit and capital and equity, and I'm sure others on the panel can fill on that. You just don't have a institutional high yield market. You don't have an institutional mezzanine market. And so the role for capital and credit to play in promoting growth and solving problems in that economy is enormous. And so we're opening an office ourselves there across the course of this year. We've built a big team that will focus on opportunities across the spectrum in India. We recently signed a very large joint venture agreement with an Indian company that has been involved in the Indian credit markets for a long time, Aditya Birla Capital. And we really view it as, not just a country, but a region for what we do for the long term here.
Well, when you have someday 1.5 billion people, it's hard to think of it just as a country and not a region from that standpoint. Now, Bill, when we think, when I was in school around the time of the dinosaurs, the regression analysis was kind of the thing. We could go and predict the future by looking at the past. But technology and technological disruption have told us in many ways that the future isn't necessarily going to be by the past. So when you think of risk and all this data you're analyzing, one, you're looking at historical data and different kinds, but then the issue of risk that people haven't considered, often in some books referred to as black swan risk. How do you manage this to try to predict how you're going to invest or what analyzing this data is telling you about the future versus about the past?
Well, when we think about macro events, we should distinguish between the macro events that are predictable, the ones that you can break down, the ones you can understand, the ones you can have data to support a decision on, and those which are more like coin tosses, where there just is enough history in the past, it's more of a coin flip, it's an inflection point, or it's a tail risk, and things of that sort. And sort of having the judgment, which I think is what humans bring, to know the difference between what are you expecting and what are you facing is very important. I think the former, humans are good at it, and I think computers can be as good, if not better, at decomposing those risks, at preparing for it, as using data to do this. So when we think about trade wars, I think that that is something that you can very systematically, you can build an algorithm to understand if US does this, China will do this, the following company has this kind of exposure, more likely, less likely, etc. So some of those things can be decomposed. When you think about things that have surprised us in the last few years, Brexit or other elections or things of that sort, or other inflection points in the markets, those things are just very hard to predict. So our posture on that is to recognize that and to try to immunize ourselves against going into that inflection point, because we recognize that we can't predict those. Now that said, in the midst of that inflection point, you can try to collect data. And then coming out of that event, you can probably position yourself better to understand how to benefit coming out of that event. But I think knowing the difference between those two is very important. For all the talk that we have about geopolitical risks, I think that the best antidote for any risks in the market is actually just talking about it. The wonderful thing about markets is when the idea gets discussed, when the risk gets broadly discussed, the market effectively prepares for it. Participants have a way of just becoming resilient to things that are embedded in the market. That's the very nature of it. And so the things that we worry about are actually the kinds of risks that you can't do anything, that nobody's talking about. And so one thing that comes to mind is the liquidity risk. Now, we happen to trade in very liquid markets, almost by design. We gravitate towards equity markets and other macro markets that are liquid because we sort of value that characteristics immensely. But if you think of the growth in credit markets, and you think, on the other hand, of the disappearance of liquidity over the last decade, that is a concern that gets talked about a little bit, but not nearly enough. And I feel that people may be lulled with this sort of low volatility environment and not realizing that when the next tail risk occurs, it's going to be much more violent. And in certain markets which don't have that inherent liquidity that we've gotten used to more than a decade ago, I think that that's going to be a big risk for us.
Thank you. Michael, there are a number of areas we could go to start, but I know one of the areas we should talk about just for a few minutes is China. Yeah. And I know you've done a great deal of work over the past couple of years and visited there, and the role of trade and the idea of the Belt and Road Initiative. So among the number of topics that I'd like to address, that would be one today. And I know in the Institute's Power of Ideas book, which you could see online, you expanded about this issue as related to trade, etc. But there are many factors, and I think one of the things I was very focused on early on, more than 50 years ago, was the management team. So a lot of people were looking at numbers, but to me, who is the management team? What are their beliefs? What is the focus? Makes a great deal of difference. Great management teams build great companies and turn ordinary companies into great companies. Poor management teams can ruin a great company. So let's step up for a moment and talk about government leadership. Okay, so we're now talking countries and how that might underline. So take us to China, but also take us to looking at how you factor in government decisions and government leadership.
Indeed. I mean, there's quite an interesting chart where there's a rogues gallery, which I used last time, which people were very, very happy about, which is slide 17. You just throw that up for a minute. But to give you a sense, the reality we've got is that if we look at the world, there's a serious number of disruptors out there. There's a serious number of games being played out there. And I mean, I don't mean fun games. I mean games where people are trying to get their situation in place. So the key point that we're trying to understand is where is the disruption? Where's the value being added? And the value gets added often, for us anyway, through policy errors, through errors of fiscal, through errors of monetary, or for that matter, geopolitical errors. And frankly, we are in a very interesting part of the world here, because where we are now, and let's focus on China, because China has been, in a sense, in the future will be, with its Belt Road Initiative, growth engine for the world. Remember, the BRI touches something like 80 countries, 50% of the global GDP. It's a massive enterprise. It's a massive enterprise from China, where China is using infrastructure diplomacy to push itself into the rest of the world and to actually lead the rest of the world. And this leads to a very interesting situation. If you think about the Clausewitz thing, where he talks about war being politics by another means, let's think about trade being war by another means. And this is where I believe we are in a very interesting place at the moment.
Now, Michael, I know you had also looked at U.S. populism.
Yeah.
Maybe pull up slide 18. Maybe talk a little bit about that for a few minutes.
Yeah. Well, again, the Gini coefficient here is what's happened. We're seeing this not just in the US, but we're seeing it around the world. One of the drivers of this, of course, is QE. The quantitative easing has pushed an enormous amount of capital into the world, and frankly increased income and value of assets around the world. But it's also done another thing. It's also made sure that the current generation, the millennials do not have capital. It's gone to the other, to our generation. And if you don't have capital, if you do not have capital, why be a capitalist? Think about that. You should be a socialist, because in fact, it's the only way you can get value back. If you think about it, that we have put an enormous amount of debt here into this current economy, and frankly, that's mortgaging the future. Well, how do you dismortgage your future? Is by being a socialist. So that's actually quite reasonable. So what's happening there is we are finding a populist move around the world, and whether it's on the right wing or the left wing, it's very, very interesting that we've got quite an amount of disruption. But the millennials, there are marketing issues. The millennials, if they don't have capital, are going to be going for experiences. They're going to be investing in holidays. They're going to be playing games on the computers. They're not going to be driving cars. There's a whole lot of things which are coming out of that. Fascinating times.
So that's why I refer to Michael, someone as a social scientist. But, you know, as you think about this, I remember 1965, something insurrection in Los Angeles called the Watts riots that forced me to change my career from trying to run the space program to finance. The understanding of why would someone do something irrational, and a Nobel Prize winner later, Gary Becker, wrote a paper called Why Irrational Behavior Can Be Rational. And I think when we look at examples of Venezuelan things, what Michael has addressed here is that if I don't have capital, I'm not participating. I just want to give it to the audience that's with us here in Singapore and around the world, that the importance of inclusion of every generation, and the feeling that they have access to capital in some way, either for their ideas, is essential to reinforce that issue. Christopher, what is your reaction here? And we're going to go around again in a minute. As you're thinking about macro, Michael has challenged us on different leadership in the world and what their decision process. He's also challenged us a little bit today on different generations and how they view the world today. How does that reflect in your thinking?
I think the politics is crucial, but I think it's important to put I think the challenges we all face as investors into context, and I look at it on three different levels. First, we are, as you look at the economic data, living in extraordinary times, but the risks on the horizon, I think, are becoming increasingly clear. I did not bring glossy slides here, but in a virtual world, if you can imagine a virtual slide up above us here of the silhouettes of three dinosaurs, and there's the small dinosaur, the medium, and the large, and the small is, these are all central bank balance sheets. The Fed, of course, is topping out, and its balance sheet is decreasing. The ECB is the slightly larger dinosaur that is increasing, and the Bank of Japan is the one that is going off the upper right-hand corner of the chart. You have a much nicer slide here that our friends at the Milken Institute have provided. But it is the unwind of these balance sheets that I think are going to be the most challenging thing for investors, and it's what we're seeing right now in the headwinds in emerging markets as the dollar strengthens. And the interest rates in the US are rising at a much greater rate than in other parts of the world. The second one, and I brought a very busy slide, which shows the number of days after various political crises. I'm sure you don't have one of these. Various political crises, how many days it took the S&P 500 to rebound. And this speaks to the point about how we react as investors and how political leaders react. After the Cuban Missile Crisis, the S&P 500 bounced back within 5 days. After 9/11, it was 19 days. And after the Iraqi invasion of Kuwait, it was about 30 days. And I think what's important there is to understand not just that we have these exogenous shocks to the system, but it's how the world responds. And for example, after the Lehman crisis, the global financial crisis, President Bush was able to convene the G20 in Washington, and everybody was pushing in the same direction. The worrying thing now from a geopolitical point of view is we're not really sure where the next shock is going to come from, but how will the world's leaders respond together or against one another to manage the crisis that we have to live through? And if you'll permit me, my final virtual slide is a series of bar charts starting in 1965 and running through today. And it represents the speed, the average lifespan of a member of the S&P 500. And in 1965, the average lifespan, the average member of the S&P 500 had been in the S&P for 30 to 35 years. And my bar charts decline more or less steadily up until today because the average lifespan is about 15 to 20 years, 15 to 20 years, not including any of the decacorns and private companies that have yet to come to market. So I think as investors, we're struggling with these financial headwinds, these political headwinds, but mainly how business models and technology are forcing business models to change so rapidly.
I'd like to, if I could, go ahead, Michael.
No, just to take your point for a second, there are two things. You obviously need growth to engage people, but you also need inflation to pay off that wretched thing, the debt that we've got going on here. So no wonder the central banks are after inflation. The more the better, I guess, otherwise they'll have a real problem. Sorry.
Let's approach, this panel is focused on all sectors of investing, all capital markets around the world. And one of the things we focused on at the Milken Institute and our innovation group has been, can we create financial markets or instruments to solve the problems of the world? At the other opposite end of the spectrum, you have capital structures or companies that are being disintermediated. And Michael, I noticed you have a slide, Ilfran, I'd like maybe you to comment on Michael to start. Creative disruptors, being the trash man. If we could pull up slide 39, let's take a look at that slide and tell us a little bit about how that relates to your firm, Michael, and then Ilfran maybe talk about other examples you might address.
Okay. Well, given the fact the world is, we're going into a hugely digital world where, again, your slide earlier, Michael, showing that we're going from bricks to clicks or wherever. We've got a situation where the value is being generated in part of it, whether it's Netflix or Facebook or wherever. But the reality is we can make a heck of a lot of money out of sweeping up the balances of that are coming out of it. You look at something like Sears. Sears, the company's worth a heck of a lot less than it was worth even 12 years ago. I mean, miles less, right? But there's still value in the debt, by the by, guys.
So we're taking a look here, an example, to just look at the issue of retailers that you're referring to, Michael.
Yeah.
And if we go back here 12 years ago, they were worth $400 billion. Of that, half was Walmart. Today, they're worth less, even though Walmart's worth 60 or 70 billion. Every other company is worth, in the case of Sears you referred to, it was worth 27 billion. Today, the equity is essentially worth very little. Talk to us about how you look at Sears.
Well, again, see us as assets, and those assets are valued. Again, the way to take advantage of this is to cut the company apart, have a look at where, obviously it's still owned by the Lampert and guys, but to cut the company apart, understand the cash flows there, and understand what assets there and what levers they have to pull the value out of it.
Let's go back to slide 39 for a moment. Maybe relate to a couple of other things. Let's talk about another company you have on that list.
Yeah, I mean, Jack Wolfskin is another one. There was a very, very helpful, strong company with good brand. Similar to North Face, they make a European brand. Went into China, didn't go well. The company ended up going bankrupt. We end up owning the company, and then at that stage, you then pull more levers to take it back, value back to the investors. And again, we're going from debt back to equity, and again extracting value out of that. I mean, again, the key in all this is to actually understand where the critical cash flows are, not just looking at the overall corporate, but understanding the initial pieces of the puzzle.
Open, how does your firm look at this?
So I'm sorry, was it?
You want to go first? Go ahead.
Sure. So I was going to comment. I think that there is no doubt that data and AI are changing everything. We live in unprecedented times. So we can talk about geopolitics, we can talk about the risk, we can talk about populism, which I think is very real and a serious social and societal issue that we have to deal with. But in many ways, all of those issues get dwarfed by the immense progress and opportunity that data and AI present. And I think that slide of Amazon effectively dwarfing the entire retail sector in the world.
Why don't we pull up slide 49 just as an example? As we look at many of the most valuable companies in the world, all of which have benefited from the movement to the mobile devices that we have today.
Right, and so what do these companies have in common? They're all effectively data technology companies. And data is the new oil, as The Economist proclaimed a couple of years ago. And I think that is a very apt analogy. It is really going to rewire every industry, every company. And so there are various ways to benefit from that trend. Maybe the way that Sir Michael is describing is that you will find value in the companies that are disrupted, the company that are being Amazoned. But I think there's another way to play this as well, which is to recognize that most companies aren't being run in the data-driven scientific way that Amazon is, and that many companies can be Amazonified. And I think that there lies an enormous opportunity. If you rank Amazon to be a 9 out of 10 as the gold standard of how to run a company using data to make decisions in every aspect, we certainly believe at 2 Sigma, we try to run our company in that scientific manner. We've certainly applied our process to investment management, but every industry, every company out there is probably operating as a 0, 1, or 2 on that. Everyone goes around saying that data is their most precious asset, they have to have a digital strategy, et cetera, et cetera. But in reality, it's actually harder than you think. It's difficult to transform a company and its DNA. And there is an opportunity, whether in the private sector, i.e. private investments, or in public companies, to run those companies, to make those decisions better. Everyone talks about the explosion of data, and we've all heard the IBM statistics. 90% of the world's data was created in the last 2 years. One statistic that shocked me was only half of 1%. Half of 1% of the world's data lends itself to analysis today. So as much as people talk about data being their most precious asset, people don't know how to store that data, people don't know how to integrate that data, people don't know how to analyze that data and make decisions. And I think that the opportunity that affords creatively on the positive side for the next several decades is enormous.
Helpman, let's talk about as you're going up and down a balance sheet and around the world.
I'm glad you went first there, because I'm going to pick up on something you said, which is, one of the places we've really found a powerful way that technology and data is transforming what we do is in owning lending businesses. And so, one of the forces that we've found, and we own some very large consumer lending businesses around the world, credit card companies, unsecured lending firms. And we've typically bought those out of old financial institutions, banks or traditional lenders. And one of the most powerful things you find is actually the ability to affect change in those businesses because they haven't been able to adapt to technology, to credit scoring, to all of those sorts of things within the heritage systems of a bank or a traditional financial institution. So I think, in many ways, I think we're in an accelerated period of time here in many parts of the economy where we're seeing creative disruption. It's all a positive underlying force. It's creating the ability to do things better in many of these industries. And that force, to go back to Sir Michael's point, I mean, that force is as old as time in the credit markets. I mean, in a way, I think we focus a lot on it as a new thing because of all of the headlines around technology creating trillion-dollar companies and trillionaires. But, that force is as old as time, and the evolution of new technology and therefore the displacement of old technology and the creation of credit cycles or cycles within industries because of that is as old as time. I remember a funny anecdote in a way. The first thing I ever worked on as an analyst in credit was on one of those old big box television firms, and the disintermediating technology then, of course, was flat screens, and we're trying to work out, what would be the penetration of this wonderful new technology that now sits in front of all of us. But it's as old as time. I mean, it's really what was behind the energy crisis in a way. It was a new technology in energy, and so we're always, to pick up on Sir Michael's term for it, we're always trying to be the person that works it out, the trashman, the fundamental analyst that can work out where value remains in industries that are being disrupted by technology. And I think one of my pleasant recollections on 2018 in a way is that the world is more respectful of these things. Fundamental analysis in a way is back in vogue a little bit. I think people are more cognizant of risks in individual companies. People are more cognizant of risks from geopolitics, and you see more volatility, you see more dispersion. I think there's better value to be had. There's more risk, but there's better value to be had because we've come out of this phase of the market where literally everything was bulletproof. I think we're more in a phase this year where things are being differentiated, and that allows you to pick your spot in capital structures to work out where value is. And
Let's. I just want to pull up slide 66 for a moment to kind of reinforce some of these points that we have. So 71% of Asia Pacific workers are using data at least once a week. 66 are required at work to work with a higher volume of data than 3 years ago. Yet 80% of all full-time workers, Australia, Singapore, India, and China, consider themselves to be data illiterate. So the enormous change that's occurred in the world, moving the world itself from a level of 10% literacy to a level today 80, 90% literacy in most parts of the world. And if we factor in those areas in sub-Saharan Africa, 70 to 75% has been offset by somewhat the issues that you've raised here. Are we comfortable?
Here,
and
are you picking on us, Mike?
What was that?
You've got 2 Australians up here. Are you picking on us?
No, but I think it just underlines whether you're in Australia or whether you're in the United States, wherever you are today, you ask that question, what do you know about your customer? What information do you know? And you've related to this issue of credit that's with us. I'd like to talk about another trend that has had a major effect on markets around the world. If we could see how you see this affecting, let's pull up slide 85 for a moment. So private equity companies now in the United States control more companies than are public. And if we look at the trend, 86 over time, you can see that there's been a dramatic shift in this. And the Wilshire 5000 index that some of you might be looking at to invest, they only have 3,600 or some odd stocks today. At the peak, they called it the Wilshire 5000. It went to 7,300s, but now it's at 3,500. How do you see this affecting your investment? Let's go around.
Well, I think at Barings, because as I described to you before, we work across public markets and private markets. We see that our clients are increasingly interested in the trends in both worlds, and particularly how capital evolves. And some of these companies will ultimately come to market. There are political and regulatory reasons that are holding them back at some point, or we can talk about. But I think this is a fundamental change from the world in which we lived 10 years ago. It raises some policy and political questions in terms of what sorts of transparency government regulators have into these companies, and particularly the financial flows around them, so that as we are learning the lessons from Lehman 10 years ago, we need to remember that the next crisis is going to look very, very different, and probably crises we've learned over time come from a lack of transparency and a lack of capital cushions. There are probably better capital cushions in the banking sector right now. There are reasons to believe that the flows of private finance come from longer-term investors who are more patient and will be more patient through the next downturn. But those are questions that I think remain to be tested.
Okay, so we have a few minutes left, and we're going to our lightning round around the world. So, short answers. What are the greatest opportunities you're finding today at Varde?
Yeah, I think the opportunity that comes from large dislocations in markets is still the big thing for us. I mean, we look at Spain and Italy and India as places that just have enormous structural NPL problems, where you will continue to see opportunity by working out the complexity in those places, and where we've really built individual country or regional businesses to do that over a long period of time. I think there's a lot of value left in there, and I think at the other end of the spectrum, there's an enormous role for us to play in providing credit, either to consumers or companies or countries where it's not being provided well, and we really think about building the infrastructure to do that well. And you always ask a question in these conferences, can you guys find structurally ways to earn 8% returns in a world where rates are low? And I do think, across the course of this year, the market is giving more of those things because there's more dislocation. There's so much focus on what's happened in places like the United States where markets are strong and credit spreads are tight. But in many other places of the world, you're seeing a lot more dislocation now. And maybe that's the next deep distressed opportunity waiting to happen, but on the way through, and to pick up on Noble's point from before, as liquidity en masse tries to move out of places, Turkey, Argentina, emerging markets in general, it leaves behind these gaps and these dislocations that are really creating very good quality ways of earning returns in credit.
So Nomel, the team's getting together, you need to write some new algorithms to figure out how to adjust the world. What are the pressing opportunities that you see that might change the model of how you're approaching? What data aren't you getting that you'd like to get?
Well, look, I think we have more than 10,000 data sets, so there's no one data set that makes is transformative. But and we're hard at work in our core liquids business. I think that it's a million things that add up to make what we do work. But if I were to name one big opportunity, I think it would be China. China has got an immense amount of data, some very, very deep markets, an enormous amount of talent. And one day the Chinese market will rival the U.S. market in terms of its scope, size, and depth. And so we are just scratching the surface there. I think that there is an enormous opportunity there. Outside of our liquid markets business, which is the vast majority of what we do, we have over the last decade been able to expand in the insurance business, in the securities business. And really the opportunity there, more broadly thinking, is to see whether we can apply our data science capabilities to a range of other adjacent companies. Maybe even partner with a private equity firm to go help portfolio companies transform themselves by using their own data to run their own businesses better. And so I think that we, in one word, we would be long AI and data.
So, Sir Michael, I think I once read that you commented something like, there are great opportunities in crisis. Now, there's some politicians that will tell you never let a crisis go unused from that standpoint. But you're much different in this issue. You're focused on creating value and creating opportunity, sometimes where others see fear or crisis. How would you articulate that to the group?
Well, again, the hard work and imagination is where it gets. You need to be. We live in an asset-light, cov-light world. We've always had to go and do very fundamental work, whether it's in the public markets or the private markets. And again, once you understand where you are, once you understand the value, you can actually hold yourself in good stead. When we were looking in 2016, when everything was looking terrible, we looked back at the cash flows, and I was able to double up. And that's the point.
And I was so disappointed that I didn't have my entire net worth with you when you generated 30% that year.
Yeah, well and again, thank you for the plug. But the point is that. But
next time you need to call me more often.
I will. But again, if we hadn't done the fundamental work beforehand, we wouldn't have been there. We would have been washed away with the fear. It's the fundamental credit work, and also thinking about where things are, and that's the key.
You often have spoken, even today, about imagination. In the case of Two Sigma, we're talking about people that are scientists, engineers, physicists, and others that come and working with big data, statisticians. What does the person look like that you're looking to hire that has that imagination?
Our history is not a bad place to start, you know. I mean, it's somebody they need to be numerate, obviously, but the point is somebody who wants to think outside the box, who really wants to take things to another level, because otherwise, you know, it's hard to compete against a machine. But the machine does not have imagination.
Wait a minute, are you telling me Two Sigma is a machine here?
It really is. I mean, have you ever tried to trade algos? Have you recently tried to trade orange juice futures? Good luck, guys. I mean, there's algos in there. You try to trade 10 contracts. They'll give you 2, and they'll hammer the other 8 in your face. No, I mean it's a different world. But again, yes.
Humans have a very important role to play in AI companies as well. I think humans bring judgment and context. And I think we're still a long ways away from general AI, where computers are doing everything on their own and there's no place for humans. So we employ 1,500 people. There's a good reason for that.
Yeah.
So let's go to Barings. You span all continents, I believe, except for Antarctica. You have a very small office.
Not yet. It's coming, right?
How do you get a common vision across the world that you span today?
Well, I think the common vision is what helps you focus because there's so much data and so much information coming across our desks every day, and we try and look for things that are durable themes. I have a colleague who likes to call it permanent knowledge, things that will help us become expert in the way countries evolve, the way technologies evolve, and the way, as I was saying earlier, monetary policies evolve. But you also have to have a local presence, and you have to understand the context in Japan is very different from the context in Britain, is very different from the context in Brazil. I think we look for opportunities in dislocations just as everybody else does, and the trick is to understand how history rhymes. That it's not going to be exactly the same as the last 2 times, but there will be similarities to watch out for. But there's always that human element that makes it much more difficult to predict. I was struck with the idea of being able to predict the escalation of our trade war with China. There are obviously some things to be able to analyze there, but so much I think is driven by personalities. And having spent some time in our government, it is much more like an episode of Veep than a computer algorithm. And I think that is what makes the imagination, married with a discipline of quantitative analysis, a key to success.
So I want to thank all of our panelists. You got a chance to hear from 4 individuals who actively are involved with some of the leading money managers in the history. But also we've seen both spans. We've seen the data issue that's coming on track and the ability to make better credit decisions, the deployment of data in money managers and financial world, the fact that most companies in the world today are not really taking advantage of analyzing and deploying that data. We've seen the challenge of imagination and the issues to understand the human being and its involvement in capital markets. Thank you for joining us, and thank you for joining us today.
Thank you.